Hi, I'm Garrett Cayet, SFMG's Chief Investment Officer. I want to recap the first quarter of 2024 and talk about some of the items we'll be focused on in the upcoming quarters. So in early 2024, stocks continued their upward trend. The S&P 500 hit multiple new all-time highs, and unlike 2023, where tech sectors dominated, this rally has been a little bit more broad-based across various sectors and industries. The rally is even more notable given the significant change in expectations around interest rate cuts. Investors are now expecting only 2, maybe 3 rate cuts this year, compared to the initial projections of up to 6 when we entered the year. That change in sentiment reflects a slowdown in inflation progress, but a continued U.S. economic expansion, both of which are signaling a reduced need for those extensive rate cuts. And now as we enter into the second quarter, we continue to be in a relatively positive macroeconomic environment. Growth is steady. We're not yet seeing any significant broad-based reacceleration in inflation. And despite that, the Federal Reserve may still cut rates at some point in 2024. And finally, artificial intelligence optimism is continuing to boost earnings estimates. But we're balancing some of those positive factors out with a less positive valuation environment. The strong rally we've experienced has pushed the S&P 500 to historically high valuation levels where we believe make the market a little bit more vulnerable to negative surprises. Looking forward, there are some other items we're focused on as well. First, the U.S. presidential elections. Elections typically bring uncertainty into the marketplace and thus volatility, particularly in the second half of the year as the election nears. Next, U.S. economic growth. Although it has remained resilient overall, we are starting to see some slowdowns in certain areas. For example, the retail sales reports in the first couple of months of the year missed expectations, and recently the unemployment rate hit its highest level since 2022. And getting back to inflation, although it did retreat through a lot of 2023, it has slowed in its decline. And now, as oil prices have continued to rise through a lot of the first quarter, it's likely that that will put some upward pressure back on inflation. Falling energy prices helped ease inflation data over the past couple of years, but now that trend could change, especially as geopolitical risks rise. All that to say, it's likely going to be a little bit of a bumpy road for the Fed to achieve its 2% inflation target. Ultimately, we are pleased with the market performance, but we remain focused on managing risk across the portfolios. We're continuing to monitor Fed policies, inflation trends, and earnings growth to help guide our investment strategies. Thank you for listening, and if you have any questions about your portfolio, please feel free to reach out to your SFMG team. Thank you.